The recession of 2023 was probably the most predictive recession that we've ever not really had yet.
Our view has been for some time that you will confront a recession in 2023.
By the summer, we'll start to see a recession unfold.
We think that a recession is necessary. We're looking at something like a 1.5% peak to trough decline.
I say recession is inevitable. The low and high yield or the widened spreads is always during recession.
Everyone predicted that it was going to be really bad. You had economists on TV and everyone here on YouTube saying, get ready for what's ahead. But almost at the end of the year, we've had pretty much the opposite. The stock markets have rallied and had some of their best ever starts to the year. We've got the S&P 500 up 16% so far, and then the tech-heavy Nasdaq index up nearly 40% in just a few short months. Unemployment is still around all-time lows, both here in the UK and over in the US. And then the dreaded inflation numbers, in the US at least, have fallen faster than the value of Spider-Man NFTs. So does that mean that the recession of 2023 is cancelled and everything is fine, or are we still in the everything bubble? It's a scary word, recession. Nothing gets the pundits on TV fired up or the headlines pumping like the dreaded R word. But really, this is all part of the normal economic cycle. Now, since World War II, we've had recessions on average around every 5 years or so, and they've lasted, on average, for a period of 10 months. Now, interestingly enough, if you go back even further to 1854, the average recession lasted even longer at 17 months. Recessions can have some major effects on the economy and the stock market. Now, for example, in the last major recession caused by the global financial crash, unemployment in the US peaked at almost 10%, and the S&P 500 fell by more than 50% at its lowest point. But then, just for some contrast, technically the last recession we had was caused by the global pandemic, and this lasted just 2 months. Your guess really is as good as mine when it comes to guessing how bad or how long a recession will last. Now, a recession is quite funny because we can't even agree on what the definition is. Now, many people would have heard that a recession is 2 periods of negative GDP growth, so that's 6 months worth of the economy getting smaller. It could be as little as minus 0.1% twice in a row, or anything much worse. Now, over in the US, it's only an official recession if the National Bureau of Economic Research agree, and that is, they say, a recession involves a significant decline in economic activity that is spread across the economy and lasts more than a few months. In our interpretation of the definition, we treat 3 criteria: depth, diffusion, and duration as somewhat interchangeable. So, in other words, we'll decide when we want to call it a recession, so it's not even a straightforward thing. Just going back to GDP, the latest data from the US and here in the UK has actually surprised a lot of people and confused lots of very highly paid analysts who seemed absolutely sure that a recession was going to hit. In the latest figures here in the UK, which came out this month, the UK economy actually grew by 0.5% in June, which meant that for the previous 3 months, going back to April, the economy actually grew by 0.2%. I mean, it's not exactly setting the world on fire, but then, as you can see on screen, we're not getting those 2 quarters in a row in the red. Now, jumping over to the US, their GDP actually grew 1.1% in the last quarter, which is 3 quarters in a row now where they've been seeing positive numbers. It wasn't long ago when they actually did have 2 quarters of negative GDP decline, but technically they didn't want to call it a recession because, well, you know, we don't want another one too soon. Right, putting this to one side, we're still in 2023, so truly anything can happen. I'm also not some kind of guru who tries to predict the future and guess when a recession will actually happen. But let's just pretend for a moment that you could predict the next recession down to the exact date. What would you do with that information? Hopefully you said try and make a lot of money in the stock market. I'm sure most of you are thinking that. But hang on, I didn't say you can predict the bottom or the top of the stock market. I just said you could predict the next recession. You see, even if you did have that amazing crystal ball that some people in the comments section claim to have, using that to predict the stock market is a whole different issue. Now, if we put the S&P 500 as our benchmark and then draw on shaded lines where recessions have taken place. Now, I've grabbed this from Yardeni Research, and this goes back all the way to 1921, so we get quite a lot of recessions to choose from. Now, back to the point, you've got the power to know exactly when the next recession starts and ends to the exact date. So my question to you would be, at what point are you buying and selling to make all of your money? If we start with selling, let's pretend you're all invested right now. Fair to say, you'd probably say you'd sell just before the recession starts, maybe a few weeks or a month or 2 before. I mean, looking at the chart, I'd say that seems fair. Pretty much before every recession appears, the stock market's peaked fairly closely before it. So That's the first step done. Now, the next question, buying back in. Again, I'll ask you the same question. At what point in this recession, which you know exactly the end date of, do you choose to invest again? I think this part gets a bit trickier. Picking a couple of examples, the dot-com bubble is a good place to start. If you knew when the recession was over, would you say that you would have bought back in just before it ended? Well, as you can see, if you had done that, technically the stock market hadn't even reached the bottom yet. The stock market actually took another 18 months to bottom out. On another example, what about the last major dip from the Great Financial Crash? Now this one looks a bit more traditional, I guess. The market bottoms toward the end, so a fair bet would be to say you make all of your investments a week or two before the end of the recession. Generally, I'd say that would be a safe bet for most of them, but still, I hope you get the point that even if you could predict recessions, the stock market can do and will do whatever it wants. Now also, in between recessions, you can have plenty of bear markets where the stock market dips more than 20% without the need for the recession to actually happen. So don't go looking too smug with your newly found crystal ball. In fact, since 1928, 14 bear markets happened during recessions, but 11 other bear markets have had nothing to do with the recession. Talking of all this trying to time the market just brings me back every time to legendary investor Peter Lynch when he said, far more money's been lost by investors in preparing for corrections or anticipating corrections that has been lost in the corrections themselves. Honestly, even if you did have some mystical knowledge, I'd be wary that you could still end up making some very risky decisions. And if anything, it ties this all down to the next part of this video, human nature. Many of you would have seen this before. It's the Greed and Fear Index put together by CNN. It's a measure of a number of factors, but I think it helps explain some of what goes on in the stock market. Basically, the higher the number, the more the market's driven by greed, and it could be too expensive, and the lower the number would suggest that people are being driven by fear and maybe selling off too much. If we grab this index and look at a timeline, let's just see if something like this can even help us. On these lowest points, I want to see if this would have been a good time to invest in the stock market and see whether or not it's worth trying to predict recessions. So, end of September and October of 2022, we were at some of the lowest points. And if I quickly check it around what the S&P 500 was, it was at 3,500 points around the end of September, just when peak fear was setting in about high inflation, raising interest rates and slowing growth. In hindsight, pretty good time to buy if you look at today's price of almost 4,500 points. Now, what about the other dip in the middle of March 2023? Again, not a bad time to buy at 3,900 points. So if anything, what it was trying to show here is that when people are worried about a recession and generally negative about the stock market, it's actually a better time to buy than when everyone is euphoric and thinks stocks can only go up. The long-term winners in the stock market aren't the people who buy because of fear of missing out, it's the people who have the guts to buy and keep buying even when everyone else thinks the worst is yet to come. Now, quick caveat here, obviously if you buy penny stocks and trash companies, then they can and will go to zero. But generally speaking, for the wider market, if you're an index fund investor, these are the times when you make greater long-term profits by making sure that you keep making a lower average cost. In fact, just on that point about individual companies, here in the UK, of the 100 companies in the FTSE 100, in 1984, only 24 were still around in 2012, which I bet is even less now in 2023. So just be careful, none of this buy the dip mentality works with individual stocks. So could a recession still come? Absolutely, and they're just part of the economic cycle. Unfortunately, it's the price of admission. If you want to have the potential gains of the stock market, you have to accept the volatility, which comes in the short term at least. But one thing I would say is that regardless or not whether the next recession is coming soon, the recession itself, I don't think, is the most important factor. Now, as an investor, how you react to it and what you do is really what counts. You see, our biggest issue as investors has to be really what's going on up here rather than what happens in the stock market and the economy. Andrew Craig, fund manager and author of the book How to Own the World, recently sent out a newsletter titled Pessimists Sound Smart and Optimists Make Money. Now, I bring this up because in the email he explains the issues we face when trying to invest, but also reminds us that we just need to zoom out and try and think long term. So much value has been created in the stock market over the long term, with a huge amount of wealth that's been made, yet so many people along the way would have sold everything or not even been aware that they could have taken part. He points out an interesting fact that here in the UK, just 5% of the adult population have a stocks and shares ISA, which for anyone outside the UK is just a tax-protected investing account. I think the reason for this is that financial education is just something we don't do very well. I know I just fell into this world and there's no way my parents would have been able to teach me any of this stuff. So what do you think happens when you keep hearing day after day stories about a possible recession in the news, or just how bad the economy is? You certainly are inspired to learn about investing, that's for sure. If anything, you're kept even further away because it all just sounds too dangerous. Now, tying this back to an upcoming recession, let's say that you see experts on TV predict that there's going to be a recession. You're new to investing, or you're just starting to look and think about ways to try and make money. An expert who's been in the business with a smart suit talking fancy words is saying that things are not looking good. What effect do you think that has on most people? Now, unfortunately, the answer is pretty obvious and goes back to the title of Andrew's email. Pessimists sound smart, optimists make money. One of the flaws in our little human brains, alongside lots of other mental biases, is an issue we have called narrative bias. Now, we like to explain things using stories and understand complex problems using simple cause and effect, i.e., recession ahead must mean stocks go down, this is bad, therefore don't invest. And while they partly might be true, as a long-term investor, the funny thing is that downturns and recessions are great opportunities to make money investing, especially if you regularly invest even without thinking about it. In fact, if you ever want proof of this, remember that over the last 200 years of the stock market, the average returns of the market, once you remove the effects of inflation, has been almost 7%. And once you compound that year after year, that is a huge amount of money, but only works if you invest with that long-term mindset. During that period, just think of all the wars, stock market crashes and political meltdowns that have happened, which would have given you plenty of reason to pull out and expect the worst to happen. Bad things do and will always happen, including recessions, but I'd be very careful about choosing to invest based on what's happening, as more than ever, there's plenty of bad news to pay attention to. So look, you might have heard this one before, but in a 1966 Newsweek article, the famous economist Paul Samuelson said, the stock market has predicted 9 of the past 5 recessions. The funny thing is, the same could be said about economists and analysts almost 60 years later as well. And I'll bet that in the next 60 years or so, you'll see even more predictions of recessions than that. Anyway, until next video, happy investing.